Hi everybody, Joe Gentili from Left Tail Risk Advisors. In this video, I want to go through a misunderstanding that's common for people when they're shopping for life insurance. And that's the misunderstanding is that when they're shopping for life insurance, they tend to treat it like a commodity in the same way they would treat their homeowner's insurance or their auto insurance, meaning that they primarily shop based on price. They assume that the products are kind of the same thing, and you could differentiate them with the lowest priced one being the best. That's not true with life insurance. Life insurance is one of those areas of insurance, almost uniquely, where the price and the value do not really equate. And I'm going to go through why for the major different the major categories of life insurance. So first, the simplest type, and the one that is probably the most commoditized, which is term life insurance, and even that's not really a commodity. The reason why it's not a commodity is that, well, I would say two reasons. So number one, any insurance policy is only as good as the company that's backing it. And there's a wide range of stability amongst insurance companies. So some are, if you look at their Comdex scores, some are very high in the high 90s and others go much lower than that. Obviously, all other things being equal, you prefer to have a policy issued by somebody with a high score versus a low one. The strength of the insurer matters. So that's one. Number two, and less obvious, is that the contracts are not the same. The biggest point where term insurance contracts differ is on the conversion privileges. The ability the ability to convert that term life insurance policy into a permanent life insurance policy if you choose to. How long throughout the term do you have the ability to convert? And if you do have the ability to convert, what products can you convert it to? And there's a wide range in this area. And I've heard it said that some actuaries say that the most valuable piece of a term life insurance policy is not the death benefit. It's not the most actuarially valuable piece. It's the conversion privilege. The reason for that is because for most people that have a term life insurance policy, the odds of them dying within the term are much lower than the odds of them becoming uninsurable at some point during the term or having a serious illness that may result in death at some point just outside the term. And so for people that have that, the conversion privileges are very valuable because it allows them to continue to have coverage after they become uninsurable. It allows them to continue to have coverage in the event that not just that they're uninsurable, but that their life expectancy may be very short after the term. Plus, in addition, for some people, that policy, that term policy, having that conversion privilege makes the policy sellable. You're able to sell it in a life settlement, so that could be converted to cash in addition to having a death benefit. So that's term life insurance. So even the most commoditized version of life insurance, it's not really a commodity and the price doesn't tell the whole story. So then we look at whole life insurance. Whole life insurance is of the permanent life insurances, it's the, let's call it the original form. It's probably the most simple. And if you're looking at whole life insurance, dividend paying, participating whole life insurance issued by one of the big four mutual companies, it's considered probably the safest asset amongst life insurance to own. The policies have a guarantee that as long as you pay the premium, the policy is guaranteed to stay in force. Those policies are also dividend paying. So if the life insurance company overcharges for that premium, if they have assumptions in there that are overly negative, and they mostly do, just for the nature of how whole life insurance works, or the life insurance company has profits, that comes back to the policyholder in the form of a dividend. What that does is it effectively guarantees that over the long term, the pricing for whole life insurance is going to be fair. So if the premium that they're charging policyholders is expensive and that results in excess profitability for the life insurance company, since the policyholders are the owners of the life insurance company, that comes back in the form of a higher dividend. If the life insurance company undercharges, if they charge too low a premium, that comes back in the form of a reduced dividend because then that negatively impacts the profitability of the company. And again, the policyholders are the owner. So over time, that dividend mechanism ensures that there's fairness in pricing with whole life insurance issued by one of the mutual participating whole life insurance companies. So finally, this is where it gets most tricky is with the universal life chassis. So, and I'm not talking about guaranteed universal life insurance policies. I'm talking about index universal life, IUL, variable universal life, or straight universal life. This gets a little tricky because this is the one area of insurance I could think of where premium and cost of insurance are not the same thing. All other areas of insurance that you have in your life, your homeowner's insurance, your auto insurance, if you pay the premium, that is the cost of the policy, and as long as you pay it, the policy stays in force. That is not true with universal life insurance. With universal life insurance, your premium is a suggested funding amount. And you're going to get illustrations when you buy this policy, and that illustration is going to contain some assumptions about the policy, one of them being the rate of return on the cash value in the policy, how that policy is performing from an accumulation standpoint. And you're gonna fund the policy according to that assumption. And if that assumption turns out to be overly optimistic, then over time, the premium that you put in will not be enough to cover the actual cost of insurance in the policy, and the policy could lapse. So it's a common occurrence if people are not checking up on these policies on a regular basis that you could fund the policy exactly as the agent and the carrier said for decades, and it could still lapse within a person's lifetime because you funded it according to certain assumptions. Those assumptions turned out to be too rosy. And in order to keep that policy in force, if you were checking up on it, you'd see that you'd have to add in additional cash to keep that policy in force, but that wasn't done. So that's something really important to keep in mind with universal life insurance policies. The other thing to keep in mind with it is that there's an incentive built into that sales process with universal life insurance where the carrier and the agent, they have an incentive to project or to illustrate very rosy versions of how those policies are going to perform. Why? Because they want to make the policy look better. They want to make it look like a great deal. So they tend to emphasize what the policy could do under good assumptions, not what the policy is guaranteed to do. And so they're doing that to induce people, obviously, to buy the policies. So it's something really to keep an eye on. And so with universal life insurance policies, because it doesn't have those guarantees in it that whole life insurance has, if you fund the policy and the policy underperforms, the insurance company doesn't take the risk of lapse. You, the policyholder, do. So yes, you may be funding it at a lower price than other forms of insurance like a whole life policy, but that lower price could turn out to be much higher over time if you have to then kick in more cash to keep the policy in force, or even worse, that lower price is transferring the risk of a lapse from the insurer to you. So what you're getting for that lower price is a lower probability that the death benefit is going to be there when you need it. So it's not to say that these types of policies are bad. It's just that there you have to understand that it's not just a lower priced policy, it's a higher risk policy. That's the reason for the lower price typically is the policyholder is assuming risks that they wouldn't in other forms of insurance like whole life. So it's best to keep this in mind when shopping for a life insurance policy that the price doesn't tell the story because these are not commoditized products. Carriers are different. Some carriers are stronger than others. The form of ownership of the life insurance policy may be different, like with a mutual company, the policyholders own the company. With stock companies, there's shareholders that are also getting paid. And then the contracts are very different. The whole life insurance contract, as long as you pay the premium, the policy stays in force. Universal life contract, again, excluding guaranteed versions of the contract, there is a suggested funding amount. It's flexible how much you want to put into it, but the policyholder owns the risk that the policy will be underfunded and lapsed. So the less money you put into that policy, the higher the risk of a lapse. And then with term life insurance, the contracts are different. The conversion privileges on these contracts are very different, and therefore the value of those policies is very different over time. So you can't just simply look at the price. Okay. Any questions on this topic, please feel free to reach out at any time. I hope this was useful. And if it was, I encourage you to like and subscribe to the video. Thank you.